I've heard a lot lately about the 28% tax on gold and silver as collectibles, making them unattractive ways to build wealth. I don't personally blame anyone for holding this belief. There is so much information out there that it's virtually impossible to question everything we hear, and so most of us will simply accept on faith that something we hear is true. I'd like to dispel this widely held belief about the 28% tax rate on collectibles, because it makes gold and silver look much less attractive as savings vehicles than they actually are. I'll have to apologize to my viewers outside of the US. This will be a US-specific discussion, but you might still find it interesting. For everyone else, fair warning, I'm going to go through a tax example here. It will probably be boring to most, but I think you'll find that by following along at the end of the video, you will come away with some valuable knowledge. So with that said, let's do a case study of a married couple who saves their wealth in gold eagles to fund the first few years of their retirements, the years before they start drawing Social Security benefits. They reach age 65 and decide to sell $115,000 worth of gold to meet their spending needs. This is a pretty significant amount of money for most people, and many would assume that they would be penalized heavily on this sale. But what is the reality? Let's find out. First, let's take a look at a blurb from the IRS website on capital gains. And I should mention to you that everything in this presentation is going to rely solely upon information directly from the IRS. I will use no other sources because I want to make sure that we get this right. You can pause this video and read the text on your own if you choose. I just want to highlight a key word here. Take a look at the section where it talks about capital gains that are exceptions and might be taxed higher than 15%. Item 2 here talks about collectibles. See that word that I underlined next to the phrase 28% rate? That word is maximum. So right away we have a clue that the 28% rate on collectibles will not be a hard and fast rule. It will not apply to everyone. It's a cap on the taxes that you will pay on the appreciation of collectible items. Most people simply stop when they read the 28% rate and assume that's how collectibles are taxed. Let's do our detailed example and find out how the tax code will apply to ordinary people. The first step to calculating taxes, if you want to understand the details that is to obtain a Form 1040 from the IRS website. Our couple has done so. Let's start filling it out. We'll go through this fairly quickly. I'd encourage anyone to go back and redo this exercise if they care to verify that it is correct. The couple starts out by checking off the fact that they are married and filing jointly. They don't have any kids living with them, but they get to check off the fact that they have 2 exemptions, one for each one of them. This will turn out to be important later because it actually applies to the tax treatment on their gold sale. Going down the form, we don't need to fill out much because there are no other sources of income. The only question we have at this point is what do we enter on line 13? This is where we need to enter our capital gain for tax calculations. The form tells us to attach Schedule D, which is the form that the IRS requires to describe capital gains. So let's grab Schedule D and start filling it out. Here's the Schedule D form. The first section is for short-term capital gains. Our couple has held their gold for well over a year, so we can skip this section. Let's move to the section on long-term capital gains. Here's the long-term section. We don't really need to enter anything in this section until we get to line 10, which is for the sale of special items such as collectibles. But what do we need to put on this line? Well, we need to go to Form 8949 to find out. So let's do that. Here's Form 8949. It's for the sale or disposition of capital assets. Well, that's the situation that we find ourselves in, so let's fill it out. Again, the top section is for short-term gains, which is not the situation of our couple. So let's move on to the bottom of the form, which focuses on long-term gains. In the long-term section, we'll start describing our sale. The couple sold 100 gold eagle coins, so we enter that in column A as the description. In column B, we need to enter the date acquired. We'll assume for the sake of this exercise a date fairly far in the past, so that the capital gain will be significant. Assuming the end of July of 2006 will mean that the coins nearly doubled in price. If the couple bought on that date, then the cost of their coins would be close to $65,000, which is the number that we'll put in column E as the cost basis. The proceeds of the sale was $115,000, which is what we'll put in column D. In columns F and G, we need to put in a code and an adjustment based upon the instructions. I read through the instructions and will spare you the details here, but in column F we need to enter a C for collectible, and in column G we enter 0 because there's no adjustment. This leaves us with a gain to report in column H of $50,000. Once we have all of this recorded, we simply need to carry the entries down to the bottom of the form because we have no other gains or losses to report for this year. And so now we can go back to Schedule D and carry this information over from the 8949 form onto line 10. We have no other gains or losses to report, and so the $50,000 we entered onto line 10, column H, gets carried down to line 15. Now we can move down the form and see what further instructions the IRS has for us. According to the instructions, we need to combine lines 7 and 15 and enter the result on line 16. In other words, this is the combination of short-term capital gains and long-term capital gains. All totaled, we have only a $50,000 long-term capital gain, and so this is what goes on to line 16. Line 17 asks us for both our long-term gain and combined long and short-term gains, and asks us if they are positive. The answer to that is yes, and so we check the box. And the instructions tell us to move on to line 18. Uh-oh. Here's where the instructions tell us to go to the 28% rate gain worksheet. If we're going to get hit with a 28% rate on our sale of gold, this is where we're going to learn about it. Let's go to that worksheet and see what it tells us that we need to fill in for line 18. Here we go. This is the 28% rate gain worksheet. We need to fill in $50,000 on line 1. We didn't categorize our sale as category Q, so we can ignore the second step. By the way, category Q is a small business stock for anyone who's curious. We can also ignore step 3 because it asks for information from a form 6252, which is for casualties and thefts, which is not our current situation. We can also skip step 4 because this asks us for gains that were reported. Our transaction, because it was Gold Eagles, would not have been reported, and so we have nothing to enter onto line 4. We have no long-term loss carryovers, and so we leave line 5 blank too. Our transaction didn't generate a current loss, and so line 6 is also left blank. So at the end of all of this, we're left with a $50,000 entry on line 7. The instructions tell us to put this entry onto line 18 of Schedule D. So let's go back to our Schedule D. Okay, back to Schedule D. We enter $50,000 onto line 18 and move on. We don't have anything that we need to enter onto line 19, so we move to step 20. It asks us if line 18 and 19 are both 0 or blank. The answer to that is no, so we need to check no and follow the instructions. It says that we need to complete the Schedule D tax worksheet. Boy, this is getting pretty complicated, huh? No wonder nobody knows how precious metals are taxed. Let's go to the Schedule D tax worksheet and fill it out. Now, assuming that you're not lying on the bathroom floor in a pool of your own blood after having slit your wrists, you'll be sitting in front of your computer looking at this Schedule D tax worksheet, and we're going to start filling it out. And of course, right from the very beginning, it tells us that we need information from another location. In step 1, it tells us to enter our taxable income from the first form that we were filling out, the 1040. It says to enter our taxable income from line 43. Right away, this should clue you into something important. Why would the tax rate on our sale of gold require a knowledge of taxable income? Well, the answer, quite frankly, spoiler alert, is that the tax rate is set by your income level. Let's go to the 1040 form and see what we need to enter here on line 1. And here's where the magic happens, folks. On line 38, we have our adjusted gross income of $50,000. This is how much the couple generated as a gain from the sale of coins. Now we need to make some other adjustments based upon filing status and personal circumstances. In this particular case, we're assuming that our couple are both 65 years old. This will turn out to reduce our tax burden, and so we check both boxes on line 39. The instructions tell us to enter a 2 in the box on line 39. Now we can move on to line 40, and this one comes with special instructions. I'll spare you the details now, but I do encourage you to check them out when you have time. Our married couple, because they are both age 65 or older, will have a standard deduction of $14,800. This is income upon which no tax is due. If they were under age 65, the standard deduction would have been $2,400 lower. We subtract the standard deduction from the $55,000 income and are left with $35,200, which goes on to line 41. This brings us to line 42, which is for exemptions. Our couple gets to take 2 tax exemptions, one for each of them. Each exemption is worth $3,950 off of their taxable income, and so we enter $7,900 on line 42. We subtract this amount from the $35,200 on line 41, and this leaves us with a taxable income of $27,300, which we enter onto line 43. Now we finally have enough information to go back to the Schedule D tax worksheet to fill in line 1. And so now we go back to the Schedule D worksheet and enter $27,300 onto line 1. Now I'm sure you're all getting dizzy by now, but stick with me, we're almost done. We can skip lines 2 through 6 because they don't apply. On line 7 we enter the $50,000 that we had on line 16 of Schedule D. This gets carried forward to lines 9, 10, 11, and 12. Line 13 becomes 0. Line 14 is simply the difference between line 13 and line 1, or $27,300. Continuing on in the worksheet, it instructs us to enter $73,800 for married filing jointly on line 15. Then we're asked to compare our taxable gain of $27,300 against this number to see which one is smaller. Our gain is under the $73,800 threshold, and so we enter $27,300 on line 16. The same number gets entered onto line 17. Line 18 gets a 0. $27,300 gets entered onto 19. Line 20 gets a 0. And the worksheet tells us that if line 1 and 16 are the same, which they are, we can skip lines 21 through 41 and go straight on to line 42. That's a relief because this exercise is getting quite tedious. So let's skip ahead. Line 42 tells us to use the taxable amount on line 19 to determine our tax. So we need to determine the tax on $27,300. The instructions tell us to go to the IRS tax tables to figure out the amount, since the total is less than $100,000. I won't show you the tax tables here because I think I've bored you enough. The tax shown on the table for married filing jointly is $3,191, which gets entered onto line 19. This number gets carried forward on all of the other lines until we get to line 45. This is now the amount that we must enter onto Form 1040 on line 44. And back to the 1040 form. We enter the $3,191 on line 44 and continue with our entries. The couple didn't earn enough to worry about the alternative minimum tax and doesn't have a tax credit repayment, so we skip lines 45 and 46. Line 47 then gets the $3,191. We can skip through the section on other tax credits because we're assuming that we don't have any. So line 56 now gets the $3,191. Lines 57 through 62 won't get any entries because there are no other taxes. And so line 63 gets an entry of $3,191. Moving on. There's nothing to enter in the payment section. We finally reach the bottom of our Form 1040 and find out that the number that we enter on line 78 is $3,191. And we're done. We determined that the tax is $3,191 in about 200 easy steps. This is the tax that the couple owes. It took us a while to get here, but it was worth the trip because we can see that the couple does not owe 28% tax on their $50,000 gain from the sale of gold. They owe much less than that. Rather than owing $14,000 to the tax man, they only owe $3,191. That's more than a $10,000 difference. Don't you think it was worth a deep dive into the tax code to figure this out? So let's summarize and wrap up. We assume that we had a married couple that saved their wealth in gold for retirement. They decided to sell their gold in a year in which they were both 65 and had no other income. They weren't drawing Social Security yet. They were not taking withdrawals from their retirement accounts. They were not working for a salary. They had no dividends or interest to report. In other words, their capital gains on their gold was the only income that they had to report. They sold $115,000 worth of gold to meet their living expenses. And I should reiterate that this is quite a large amount of money for most people. It's also money that needs to get reported. Remember, the Know Your Customer laws require banks that see deposits greater than $10,000 to report these transactions to the and so it's quite dangerous in today's day and age to hide such transactions. Anyway, our couple sold $115,000 worth of coins and calculated their cost basis to be $65,000, which left them with a $50,000 reportable gain. We went through a long, tedious exercise of figuring out the actual tax due to the IRS. It was not 28%, as many will tell you is the tax rate on collectibles. The actual tax rate was much better than that. The tax code mentions a 28% tax rate, but it should be mentioned that this is a maximum tax rate. The actual tax rate is a function of your income level. If you were earning quite a bit of income in a year, and you generate a gain on gold or silver, you're likely going to pay that 28% tax rate. But in the example of our couple, they only owed $3,191, which is an effective tax rate of 6.4%. This is because they had no other sources of reportable income, and our tax code is a progressive tax code. And by the way, as a side note, remember that I said that our couple was age 65 years old? Well, even if they had been under 65 years old, regardless of whether they were retired or not, and lost the extra $2,400 worth of standard deduction, their actual tax rate on this transaction would have been 7.1%, which is not as good as the 6.4%, but it's still pretty low. The key things to take away from this exercise of mine are these. If you sell collectibles and generate gains under a certain amount, the gain will be taxed as income. If you are selling because you have to in order to meet modest to moderate living expenses, then the tax that you'll pay on the gain will be low. If you are earning a salary or have another large source of reportable income or are withdrawing money from a retirement account, then the sale of gold and silver will be much more punishing tax-wise. If you are buying gold and silver as savings and run into a situation where you need to sell them because you have no other sources of income, then the taxes will be quite modest. This would suggest a strategy of buying metals when the prices are favorable and just sitting on them. Don't try to churn them for a profit while you're in your working years, unless a large opportunity comes along that presents you with an irresistible bargain. Most importantly, don't listen to the people who tell you that gold and silver are taxed at 28%. It's just not true, folks. But don't take my word for it. Do the exercise yourself and see what it tells you about your own personal situation.